Look, there is a massive structural shift hiding just beneath the surface of today's record-breaking markets. We're navigating a financial landscape right now that looks absolutely flawless from a distance, but the moment you zoom in, the cracks are just impossible to ignore. So today, we're decoding this market illusion, and we're exploring the exact catalyst that's poised to flip the entire system upside down.
Okay, so to figure out where we're headed, we've got to lock in on exactly where we are right now. It's May 2026, and the Dow has soared past the historic 50,000 mark. Screens are flashing green everywhere, and this massive wave of absolute euphoria is just sweeping through investors. But numbers like 50,600 can be blinding. They only tell us what's happening on the surface, not the reality churning underneath.
Here's our flight plan for this explainer. We'll cover the record high illusion, uncover the cracks in the foundation, and confront the AI compute reality. Then we'll introduce the geopolitical catalyst, map out the domino effect, and synthesize the whole thing into the Great Rotation.
All right, let's jump right into Section 1, the record high illusion beneath the all-time highs.
Right now, the surface reality is painting a picture of an unstoppable bull run. As of late May 2026, the S&P is pushing past 7,500 and the Nasdaq is nearing a staggering 27,000. On paper, it looks perfect. But index levels alone don't dictate market health, right? We have to look at the incredibly conflicting forces that are actually driving these numbers.
Because we've got a massive disconnect happening here. It's a real tug of war. On one side, you have the macro pull, these blowout AI earnings with incredible metrics, like Dell generating $16.1 billion just in AI server revenue. But on the flip side, the macro drag is incredibly heavy. April PCE inflation is sitting at a 3-year high of 3.8%, and 30-year mortgages have hit 6.53%. The markets are basically just ignoring a hotter-for-longer inflation regime entirely just so they can chase that AI momentum.
So here's the crucial point. Notice the spot gamma index dropping below that critical threshold of 8. This is the danger zone. It exposes a historically extreme dispersion, meaning a tiny handful of mega-cap stocks are artificially propping up the broader indices. That is a massive contrarian bearish signal. The market is highly exposed to a violent mean reversion if the mega-cap tech thesis wavers even a little bit.
Moving to Section 2, cracks in the foundation. Let's talk about the consumer and liquidity.
This brings us to what we're calling the consumer paradox. On the one hand, the pressure is immense. That 3.8% inflation is just eating away at purchasing power, credit delinquencies are at post-financial crisis highs, and the personal savings rate has plummeted to a dangerous 2.6%. Yet somehow, the economy still appears to be spending. Why? Because generational wealth sharing, largely those healthy baby boomer balance sheets, is stepping in to fund things like discretionary summer travel. But make no mistake, this temporary cushion is masking a very dark middle-class shift straight into survival debt.
And it's not just the everyday consumer feeling the pinch. Corporate liquidity is flashing bright red too. Business dynamism is completely stalling out. Companies are terrified of the public penalty right now. Just look at Figma. They went public and quickly dropped 29% under activist hedge fund pressure to slash their R&D. So what do the giants do? They just stay private. Anthropic secured a near $1 trillion valuation entirely in the private market. And the result of all this? A mere 90 companies went public in the US in 2025. Compare that to the 1990s, when we saw an average of over 400 IPOs a year.
Section 3, the AI compute reality. Hitting the wall. We are finally hitting the physical limits of compute. That massive bill for all those compute tokens? Yeah, it's finally coming due. Corporate America is being forced to actively ration AI usage among their own employees because the operating costs are just suffocating their margins. And it's causing real collateral damage. SentinelOne actually had to slash 8% of its workforce strictly to free up the cash they needed to fund their AI capital expenditures. The AI hype requires very real and very expensive physical computing power.
Now, if you're thinking you can intelligently hedge your portfolio against this US tech concentration by just buying broad emerging markets ETFs, well, think again. The diversification illusion is breaking. A staggering 28% of the entire MSCI Emerging Markets Index is now made up of just 3 AI-linked chip companies, TSMC, SK Hynix, and Samsung. The so-called free lunch of diversifying globally has basically just turned into swapping US AI exposure for Asian AI exposure.
All right, Section 4, the geopolitical catalyst, the US-Iran ceasefire.
When we impartially track the data here, the signals pointing toward de-escalation are undeniable. Internet connectivity in Iran has normalized back to 86% of pre-conflict levels, which is a metric that historically implies the regime expects an imminent conclusion to hostilities. But more critically, a 60-day ceasefire extension has been drafted and is just awaiting final approval from President Trump. Now, the markets had already rallied on the mere rumor of this deal, but the actual confirmation is about to trigger a chain reaction that very few people are properly positioned for.
Which brings us to Section 5, the domino effect, the Citadel sequence.
This 4-step Citadel sequence is absolutely crucial because it connects the geopolitical dots directly to your portfolio. Step 1. The ceasefire leads to a full reopening of the Strait of Hormuz by the end of July. Step 2. That unrestricted oil flow drives rapid deflation in crude prices, pulling them down from around $88. Step 3. As energy prices plunge, inflation fears immediately drop off, dragging the U.S. 10-year Treasury yield down an estimated 12.5 basis points. And finally, Step 4. This provides instant rate relief, ultimately triggering a massive total asset repricing.
And finally, Section 6, the Great Rotation, the new market leadership.
So here's the ultimate synthesis of this entire explainer. Where is the smart money actually going? When that peace deal finalizes and yields fall, capital is no longer going to need to hide in the perceived overextended safety of megacap tech and AI. Instead, we're going to see capital violently rotate out of those crowded tech trades and flood directly into beaten-down, rate-sensitive cyclicals. We are looking at major fundamental momentum shifting toward homebuilders, airlines, and retailers, all of them primed to be fueled by cheaper energy and significantly lower borrowing costs.
So, given everything we've just unpacked today, from the hidden rot beneath the 50,000 Dow to the reality of the AI compute wall, all the way to this impending ceasefire catalyst, you've really got to ask yourself a tough question. Take a hard look at your own positioning today. Are you stubbornly holding on to yesterday's illusion, or are you actively preparing for tomorrow's reality? Is your portfolio positioned for the AI top or the cyclical bottom? Think about that, and I'll catch you in the next explainer.